Europe looks to Latin America for energy, Argentina pays up, and Mexico finds a growth pulse. Welcome to Weekend Sentinel from Latin America RiskSentinel.com. Thanks for being with me today. Latin America Risk Sentinel helps you turn risk into opportunity. I'm Win Trevetta II, your Latin America regional specialist. Be sure to start your day with our complimentary Morning Latam signal for the one big story you can't afford to miss. Simply visit bit.ly/MORNLATAM to get started and have the email sent directly to your inbox. This is your weekend readout before Monday morning. Every Saturday, you and I review 3 important developments in Latin America that business leaders need to know about. So, let's get started. Europe's energy search turns toward Latin America. Europe's energy insecurity is increasing Latin America's strategic value as a supplier of clean power, transition minerals, and industrial inputs. Europe is facing another energy stress point, and Latin America is becoming more attractive. The region is emerging as a strategic partner as Europe encounters energy problems. Europe needs reliable energy, critical minerals, and industrial supply chains that reduce dependence on concentrated suppliers. Latin America has the resources Europe needs, but resource ownership alone does not create business advantage. Execution will depend on permitting, infrastructure, local politics, and the ability to turn mineral and power assets into bankable projects. The International Energy Agency has already described Latin America as a major producer of minerals needed for clean energy technologies, while recent EU interest in Brazil shows how critical minerals are becoming a geopolitical business asset. For Latin America, the opportunity is clear, and so is the risk. Social conflict, regulatory uncertainty, weak transmission infrastructure, and commodity nationalism. Here is what to watch for. Whether Latin America turns Europe's energy needs into long term industrial advantage or remains mainly a source of raw materials for outside supply chains. Argentina pays up and keeps Wall Street waiting. Argentina is using repayment discipline and cheaper financing channels to build credibility without rushing back to global debt markets. The country delivered a credibility signal this week. The Malay government says it has secured the funds for a U.S. $4.3 billion semi-annual dollar bond payment while continuing to avoid international debt issuance. The financing plan relies on local dollar bonds, multilateral backed loans, and bank financing and cheaper domestic sources instead of a quick return to Wall Street. Economy Minister Luis Caputo is making a clear argument. Market access is useful only at the right price. Argentina's benchmark dollar bond yields remain near the high 8% range, while local and multilateral channels are becoming cheaper. The government says the 2026 financing plan is overfunded by 3.7 billion US dollars, and officials are now pointing toward an investment grade goal by 2031. The business risk read is straightforward. Argentina's repayment discipline is helping rebuild credibility, but the financing path leaves limited margin if election volatility, reserve pressure, or external shocks widen spreads before 2027, when Presidente Milei faces re election. The country is buying time And investors are watching whether time strengthens the program or exposes the next funding gap. What to watch for? Whether Argentina can keep reducing risk without paying Wall Street rates before the 2027 election cycle raises market volatility. And our third item, Mexico finds a growth pulse while Banxico holds the line. Mexico may be recovering from first quarter weakness, while Banxico remains cautious because inflation risks have not fully cleared. The central bank's latest minutes said Mexico's economy likely grew in the second quarter after a 0.6% contraction in the first quarter. Mexico held a policy rate steady at 6.5%, while headline inflation slowed to 3.37% in June, and core inflation eased to 4.03%. The central bank remains cautious. Long term inflation expectations were described as relatively stable, but the inflationary risk balance still has an upward bias. Mexico also noted economic slack, which reduces demand pressure and gives policymakers some room to hold rather than tighten. For business leaders, the Mexico story is about fragile stabilization. Growth returning in the second quarter would support the nearshoring narrative, consumer demand, and corporate planning. Elevated core inflation and a steady policy rate keep financing costs relative for companies looking at expansion, inventory, real estate, and cross border production. What to watch for? Whether growth becomes durable in Mexico, durable enough to support investment without reviving price pressure. Well, that's your weekend sentinel for this week. Europe is looking harder at Latin America for energy security. Argentina is proving payment capacity while waiting for better market terms. And Mexico is showing a possible growth rebound with Banxico, the central bank, still guarding against inflation risk. For business leaders, the common thread is situational awareness. Energy, debt, and monetary policy are not abstract macro stories. They affect capital flows, product timing, borrowing costs, supply chains, and market confidence. Latin America Risk Sentinel helps you read those signals before they become Monday morning surprises. Thanks for being with me today. Latin America Risk Sentinel at latinamericarisksentinel.com helps you turn risk into opportunity. Be sure to start your day with our complimentary Morning Latam Signal email for the one big story you can't afford to miss. Simply visit bit.ly/MORNLATAM to get started. I'm Winter II, your Latin America Regional Specialist.